Okay. Well, welcome to the final session, everybody. It's always a joy to be standing between you and some drinks, but we have an eminent panel between here, and I believe we have the minister coming in, so if we're swiftly ushered off stage, that is why. She is more important. We have a diverse group here. Containers is our market, but between us, I think you represent different aspects of the industry. So I'm keen to understand some of the dynamics at play in different size ranges. We've got Andreas Papathomas, CEO of Synergy Maritime, Adrian Economakis, COO of VesselsValue, Simeon Pareiras, Chief Administrative Officer of Euroseas, and Deambrosio, Managing Partner of Seamax Capital Management. Thank you for joining us, gentlemen. When you're doing these ones, it's always the job of the moderator to find the slightly esoteric questions, but I'm afraid Hamish Norton beat me to the pig question, so I'm disappointed there. Let's start with a quick view from each of you, and just give us a quick introduction in terms of the sectors you represent. Adrian, I'm leaving you out of this because I'm bringing you in on the values aspect of these things. But I just want to get a quick calibration in terms of the size ranges we're talking about. Andreas, let's start with you. Give us a view of what your market is and where you see the main opportunities and risks to the market right now.
Synergy Group are ship owners and managers of container ships, primarily charter container ships in the Panamax plus or minus size of ships. We have run investment platforms for large institutions over the last 20 years, investing in container ships. And primarily, we have found that the last decade or so has been, I think most of us all agree, a disappointment for ship investment. After the collapse of the markets in late 2008, the markets have meandered along up and down but delivered poor returns for investments for quite some time now. We feel that is partly driven by cyclical stuff, but also by structural issues involving the innovation of very large container ships over the last decade. Going forward, the challenge is to find profitability in an industry which has essentially reset itself as a result of the very large container ships. Just to finish my brief introduction, I would say that, in our view, lies in focusing on the Panamax and smaller vessels, which are priced at scrap price, where the depreciated value of the vessel would be significantly greater than the pricing of today, and by efficient operations, making a decent return without getting enormous returns.
Fair enough, fair enough. I'm going to skip over Adrian for the moment and move straight to Cal. A disappointment? Are you disappointed in shipping, or are you seeing some opportunities there?
Disappointing is too strong a word. We started investing in the 2014-15 segment. We focused on the post-Panamax segment. Our view was that with the widening of the Panama Canal, these vessels would take over the more workhorse type role that the Panamax vessels were playing. And for the most part, it's been a pretty attractive segment for us to be involved in. We started an investment program with long-term charters. Over the years, those charters have matured, and the market has been relatively strong for the last, let's say, 12 months or so. So we're pretty positive, and that's an area that we will continue to focus on.
Okay. Simeon, Euroseas has been sounding a little bit more positive of late.
We're always positive. Well, Euroseas is probably the only container company that is in the U.S. public market and invests in the feeder size, or anything below 6,000 TEUs, I would say, that we are interested to invest. We currently own 15 ships of this size, and I might say that you asked before what would be the opportunity in this area, in this sector. The way we see it is that we are in a very low asset price environment, and we are also in a sector that trades its ships to areas where growth prospects are still very good, especially in the developing part of the world. So this is a very good opportunity, the way we see it, to enter the sector. I mean, the very low asset prices are there. Looking ahead, the prospects look good for the trades that we operate. So we feel that it's a nice time to be in that sector.
Adrian, I'm going to come to you. You're not a ship owner, sadly. But what do the VesselsValue algorithms tell us about the current supply-demand dynamics? Are we in a low asset value? Is this the time to buy? Is the opportunity looming for everybody here?
I mean, so I think there's two questions you asked there. One's what's really happening with values, and also what's happening with demand and supply. So our name implies VesselsValue, that we focus on values, but we also have a great service in trade flows, cargo volume, demand, and so on, calculated in real time. So if I start with demand and supply, some pretty good stories out there. So I'll refer to the data here, if you excuse me. So if we look at the larger containers, if we take post-Panamax upwards, just in the last 3 months, we've seen cargo miles increase by about 4%. And over that period, the fleet has grown by about 0.9%. So demand growth is exceeding supply. If we look over 5 years, we've got demand growing at 18% and supply of that period growing at 12%. So in that larger sizes, there is a great demand and supply fundamental. Fortunately, if you look in the data, and we like the story on the small ships, but you just look to the data to what it says, and on the smaller sizes, let's say take the feeder max, we've had flat demand growth in the last 3 months, and luckily flat supply growth, which then hopefully is going to lead to potentially if we have a little demand shock upwards, some potential improvements in the feeder earnings. But over the 5 years, just referring to the data, we have had demand fall by 13%. Cargo volume demand for the smaller sizes actually fall. At the same time, the fleet did grow by about 8%. So you can see the disconnect that is going there. So in summary, on demand and supply, a good story currently and historically for the larger sizes, not such a great story for the smaller sizes. Just on the values, it's really the same thing there. We've seen values really increase significantly for the larger sizes. So, if we just look at if I just refer back to the real data, if we take a post-Panamax, I think the post-Panamax is the best performing asset in the shipping space by value appreciation in the last year. Our metrics put for a 5-year-old an increase for about 33% in value in a 12-month period. That beats MRs, that beats VLGCs, that beats some other strong markets that have happened. On the smaller sizes, effectively we're seeing flat. We haven't seen really any movement up or down in values of any significance. And that really echoes what's going on at the charter markets. I think the smaller sizes earnings have just come up a little bit, but it's quite small. And we do expect the improvements of the larger sizes to bring up the smaller sizes eventually, and we've seen historical correlations in the past into lagged correlation. The big ones go first and then the smaller ones follow. But so far we haven't seen that significant move happen yet.
Can I add
Please,
something to what? Yes, but what you have to observe here is that the smaller vessels had a pot of an idle fleet that had to be absorbed before you see any increase in rates, which would lead to higher asset prices. Now we are at a point where the idle fleet has more or less of the smaller vessels been absorbed. We are at a low point over the last 10 years that we are seeing an idle fleet in the sector. So it looks better now. I mean, if rates improve, the asset prices will definitely follow like the bigger sizes have.
Agreed.
I mean, while we're on the topic of asset prices, I mean, in terms of investment opportunities, particularly in the sectors that you are in, do you see available tonnage in the market? Is this the time we're going to see a flood of S&P coming through the market now? Yeah.
Sorry, I missed the first part of the question.
I'm just wondering, are we going to be seeing an increase in S&P given the asset values, given the sort of the positive market that you are looking at? Are we going to be seeing some moves in terms of consolidation in the market, do you think?
I think consolidation is necessary. It's vital. We've seen consolidation from. Sorry, am I interrupting?
If you don't mind, we can interrupt the panel to have the minister make her remarks because she has to go, and then we will continue with the panel. Sure. Is that okay?
You've been trumped, gentlemen. Excellent. Where were we? Asset values looking attractive. Market brimming with optimism and opportunity, from what you're saying. I'm being, somewhat over-positive. Does that mean that we are going to see some moves in terms of S&P? Do we see investment opportunities? Is there the available capital and finance out there to do that? I mean, you're all in a position where you could be looking at this as an asset purchase opportunity. What do you think? What should we be looking out for here? Can we start with you, perhaps? Okay. Yes.
Okay. Well, as I mentioned before, the last decade or so has been, we believe, has delivered disappointing returns in shipping, particularly in container shipping. But we also think now that the period before us is one that offers good opportunities because of the good pricing on second-hand container ships, particularly the smaller vessels, which you can purchase at prices related to scrap, far closer to scrap than the actual replacement value of the ships themselves. So you can purchase a vessel that's, say, 10 years old for perhaps half the real replacement cost of it, and earn over time, significant amounts of money as a surplus over the cost of operating the vessel. We find that in terms of availability of capital, whilst the conventional lenders have retreated, there are many other solutions involving non-bank lenders today, which offer sometimes more expensive but also more innovative and flexible financing solutions. And as far as equity is concerned, we at Synergy find that there is substantial amounts of equity interested in taking advantage of such opportunities. We continue to believe in the what we call the handy-sized vessels of these Panamax and down. We think these vessels have been underbuilt, and it's an area that the liner companies do not concentrate on. Particularly the Panamax vessel, because it's a vessel that can trade short-haul voyages and can also do long-haul. We were quite surprised to find our own Panamaxes doing Far East Europe regularly over the last couple of years. So we think that this is a good time. It's been given a shove or a push with the scrubber matter, which has pushed up the charter markets. We all know about that. That's helped, and this will give a little boost to it over the next 6 to 12 months. Beyond that, we have to rely upon world growth and the more important factors of supply and demand. But given that this is a size that has not attracted much attention in terms of replacement, we feel that this is a place that offers good returns.
Seamax, what about you? I mean, you've been making expansionist noises. What are the asset opportunities that you see?
I mean, we're very happy with our segment. Philosophically, we think the liner companies will always go for the largest possible ship they can get their hands on to have economies of scale. And that's what we focused on. So our fleet of 12 vessels, we have 8500s and 9400s. We have half of the fleet classic 85s, they're older generation, and the other half of the fleet is new generation. So we're sort of hedged from a technological perspective on that basis. In the last 12 months, we've seen about a 70% increase in charter rates, and vessel values have been mutedly going higher. But I think there's still significant opportunities on the segment. I think that's largely driven by the relatively panic there is in the equity markets. I think all the private equity money that was available, let's say 5-6 years ago, to invest in shipping, they've now moved to private credit. They want contractor cash flows. They want residual value guarantees. So it's not really equity, and that's maintaining asset value is relatively muted, still making it a very good investment opportunity. If you buy a 8,500 TEU ship today, 10, 15-year-old is going to be somewhere around mid-20s, and that vessel's generating more than $10 million a year in gross revenues, or close to $8 million in net revenue. So you're getting on a $20 million investment a unlevered IR of close to 20%. So I don't know how sustainable that is for whatever period of time, but the opportunity is there, and the supply dynamics are very positive for the next at least 24 months. We see the order book at historical lows. We see, I would call, a shyness about ordering. There's been some, but very limited, and the supply demand should stay relatively strong, particularly with scrubber retrofits taking place right now. That's absorbing somewhere around a little bit over 1% of the container ship fleet. So we're very positive overall in the segments.
How about from a Euroseas perspective? Opportunities in feeders, do you think?
We do have the appetite to invest in good feeder ships that we see in the market. We also see quite a few ships that are coming from distressed deals through the banks, mostly through the German banks. We're more cautious on these as they have been neglected due to the very poor cash flows that they have seen in the last few years. And in general, we try to be selective on our ships. So the appetite is there as far as our capabilities allow us, and the capital we have to invest allow us. We're here to be a buyer at this market. You mentioned before about the access to capital. Euroseas, we still have a good access to capital. But the fact that capital has been more difficult to obtain lately is not such a bad thing at the end of the day, because what has made our industry suffer in the last years is over-ordering. And over-ordering has to stop at some point, and the only way to stop is to limit the capital that aims to enter the sector. So I don't see the lack of capital, or not the lack, the fact that it's not as much as it used to be in the past, as a bad thing. I rather see it as a good thing for the time being, at least.
I mean, with respect to the second-hand market, I mean, you mentioned the German sort of distressed assets. Do you think there's still a few bargains to be had there, or is everything that could have been taken up already gone?
Most of them are gone. I mean, the German container sector has reduced heavily in the past 10 years. I mean, it's almost half, I think.
Yeah.
So the deal flow is not the same as it used to be, and most deals come through their banking system. There are a few deals, but not as many as they used to be.
I mean, just on that quickly, Richard.
Yeah, please.
We were seeing kind of average over the in the beginning of the year, let's say 3 to 4 sales from Germans in container vessels, and that over the last few months has disappeared. So whether that's just the summer quiet time or an indicator that possibly those vessels or the opportunities of those vessels might be slowing down.
Understood. I noticed in the last Euroseas statement that there's some positive noises, but you did mention that things like the trade spat could still upend your positive sentiment. I want to come to each of you. I mean, in terms of the sort of implications of trade war, I mean, I think the headlines have been dominated on the liner side in terms of implications of trade war, but in the smaller sectors, what's the feeling? Have we seen the...
Well, the smaller sectors haven't, the trades, I would rather say, in the smaller sectors have not yet seen an effect from the trade war. It's mostly the sentiment that is affected, and the people are scared. And when people are scared, they're more cautious. They buy less things. This is a general aspect in life. It's not only in the container business. So as long as the fear of the trade war is there, it's definitely not a good thing.
I mean,
Well, it's a good thing from an ordering perspective. So.
Yeah.
Silver linings. I mean, what's your view in terms of how we see the trade war playing out, or is that a fool's game to make predictions at this stage?
I mean, I think the trade war will have long-term implications if it continues. Uncertainty is not good for anybody, and it's clearly, we see it from our investors and our bankers. There's clearly a frightness out there that shouldn't really be there. The fundamentals, our ships are full, trade is growing not what it used to be, but it's clocking at 3% per year. Fleet is growing at less than that, and so there's really no justifiable reason why there's so much panic about it, but there is. And that creates opportunities, but also creates headways for depending on structure. We have a very unlevered balance sheet, so we can sustain ups and downs of the market. We saw it a couple of years ago after the Hanjin bankruptcy. A lot of owners had to fix with very flexible periods. We were able to stay out of the market and not lock in charters that were not necessarily beneficial by owners, but were more driven by bankers looking to lock in some level of cash flow. And that will continue as long as this trade uncertainty situation continues.
And, you know, on the trade war, from a data perspective, obviously it has reduced cargo miles from the China to US trade, but actually, on the global perspective, it hasn't had that much of an impact. You know, there are many other trades. The Asia to Europe is a very important trade, the Asia to Africa, even Asia to South America. So even we've had this reduction in cargo miles from the trade war, we still have it growing at almost 4% and exceeding, on the larger size, and exceeding the growth in supply. So just going back to Seamax and so on, the problems before were a structural problem in too many supply and too many vessels, too much large supply. Actually, the demand effect of the trade war has been pretty negligible on the global basis.
We think that the trade war is primarily a matter between the United States and China at the moment. And we're not optimistic about any resolution of that in the near future. As such, we see ultimately the trade between the United States and China as being the main culprit of the trade war. And therefore, again, coming back to my previous argument, it will have some negative impact on larger vessels, whereas the rest of the world will continue to trade with itself, amongst itself, particularly Far East Europe, but there'll be much more inside the Pacific Basin and in the Far East and intra-Asia, which again will support the fundamental economics for more flexible vessels, such as the vessels that we in Synergy run, and indeed at Euroseas as well.
I have to say, having sat between the minister and the Chinese ambassador this morning in an off-the-record briefing, I'm not exactly optimistic that trade war has run its course yet. And there seems to be some heated debate going on. But on the point about it affecting the liners and the bigger sizes in terms of containers, I'm interested to understand sort of how the liner alliance shifting over the last year, the changes at the top end size of the market. How does that filter down in terms of your strategy and how you see things panning out? Is there a direct correlation here?
Well, we think that the closer cooperation of the liner companies amongst themselves has come at a time when they also had great advances in their ability to, from a digital perspective, monitor their trades and optimize efficiency. Their cooperation amongst themselves has led to a lesser use of charter vessels. And this has made worse the structural problems I referred to earlier of the last decade, where there were owners who had vessels that were fixed for 5 or 10 years. They managed to survive these times fairly well. But where there were owners who had vessels with shorter charters, they found themselves redelivered into a world where the liner companies were operating their businesses more efficiently and didn't need them anymore. That can be regarded as a one-off. It happened, and now, from now on, vessels that will come into the system will not be brought in where they're no longer required. But we felt that it did have a negative impact on the fate of charter owners.
But it has increased the efficiency, I think. I mean, if you look at the sort of internal Maersk reports where they look at their charterers and how they rate and benchmark them against each other, I mean, the competition is fierce in terms of how they are dealing with that right now.
I agree with you. I mean, from a point of view of the slot and the consumer, this is a benefit. From the point of view of the independent charter owner, this is a disadvantage.
It's a tough business. How about you guys? I mean, in terms of Euroseas, I mean, you're down at the feeder end. How does the shift in the alliances at the top end affect how you are viewing the market right now, or is there not much?
It makes life a little bit more difficult. I mean, there are much less players. They know everything that's going on in the market, so our negotiating power is not the same anymore. Having said that, I feel that because consolidation is also needed in the owner side, this as this progresses, it will probably counterbalance to an extent the power that the liners have over the owners right now.
I haven't actually been here all day, so I apologize if I'm the one of many to be asking this question about 2020, but with sulfur cap coming in, I have to ask the question, are we ready? Are you fearing any sort of late upsets in terms of the market, or are you confident that everything is ready to go for 1st of January?
Oh, sorry.
I think from a ship owner's perspective, everybody's been working on that for the last couple of months, so it's just a switchover situation. In our business, we charter out our ships on time charters, so the fuel is all the responsibility of our charterers. There's back and forth about who's going to pay for cleaning the tanks and when it's going to take place, who's going to supply the low sulfur fuel oil to do that, and who's going to bear the cost of that. But that's all underway, and the liner companies, it's a big issue for them, and they're working through it. Regarding the supply of the low sulfur fuel oil, we're tracking it. Again, it's not our direct responsibility. Any disruption on that side will be actually helpful to ship owners because it will create excess idle fleet sitting there waiting for fuel. So I think overall it's going to be the switchover. Not only is it environmentally friendly, but it's going to be friendly for the ship owners as well.
Any other views on 2020?
I haven't got much to add, but from Euroseas side, we decided not to install scrubbers on our ships. We didn't think it made sense for the size of our fleet. Our technical departments are, of course, prepared to fully have the vessels ready for what it's needed. But I think it's mostly a charterers issue. We'll just wait and see how the market will react to this. If we're going to see slower speeds to the ships, this is what we desire. This would, of course, limit the ship supply and probably will have a good effect on charter rates. But there is not much to say in addition to what has been said so far from various people.
Understood, understood. Now, I know you've had your time robbed by the Minister, but I see a red flashing light in front of us. But any final thoughts from the data, Adrian, in terms of things you have prepared for us? I know you were looking at looking at your notes. But there's some things left to say.
Yeah, I mean, look, the main thing I want to talk about is supply, demand, and values. I did talk a lot about the larger vessels, where I actually had to make a recommendation of which container ship to invest in a couple of weeks ago. My recommendation was actually Panamax, based on not what's happened now, it's what may happen in the future. It's been a malign type, I'd say a modern Panamax, but the values have come up a bit, 20% in the last year, but they have, compared to other metrics, long-term historical averages, what's happening with supply demand, and also our macroeconomic forecast, a long way to go. We could easily see another 50% rise in values over the next 2 to 3 years. So as an asset play, I would go Panamax. Safe play, I would go larger vessels.
Very good. Well, that seems...
Thank you.
seems an optimistic point to end on. Thank you very much for the final panel. Thank you for sitting through. I know we've gone over time, but a round of applause for our containers panel.